What's going on, everyone? Today we're going to talk about the banking crisis and whether or not we are back into the same situation we saw ourselves in 2008. Because that's what a lot of people think, and I lived through it. I've been in mortgage lending for 22 years. I went through all of this from 04 to 2010, and it was a nightmare. What's going on, everyone? Today we're going to talk about the banking crisis and whether or not this is 2008 all over again. Now, what I want to show you is the biggest similarity to what's happening today that happened back then, because a lot of the things surrounding Silicon Valley Bank, surrounding First Republic, surrounding Credit Suisse, I've seen this movie before. I lived through this movie and I have like almost PTSD from it. But there's one key factor that is completely different this time around. So I want to show you some data points that are very, very similar to what we're seeing today that I think were a huge role in what caused 2008 to happen. And the exact same action is what's causing these banks to go down today. Now, the first thing I want to show you is what the Federal Reserve did as they raised rates from 2004 basically through the end of 2006. Take a look at this chart from Forbes. All right, so in June of 2004, the Fed fund rate was at 1.25%. In 2020, they dropped that to 0. So we were lower than we were back then, but the action the Federal Reserve took was very similar. What they did is they just did 0.25% raises every single meeting all the way through 2006. So in the course of 2 years, we saw the rates go up 3.75%. Now that's 3.75% over the course of 2 years. The Fed just raised rates about 4.5% over the course of 1 year. Look at how much they raised rates from May of 05 to May of 06. It went from 3% all the way up to 5%. Guess what happened? They went too far and things started to break. Now here's why 08 happened as a result of this. The loan programs that were used by most people back then were adjustable rate mortgages, ARMs. And we hear about these still today, but there's fixed terms on the beginning of them now. I'm not going to get into that. The loans that people were using back then are called option ARMs, pick-a-pays. You had a choice on what payment you wanted to make. You could make a 1% or 1.25% minimum payment. You could make an interest-only payment. You could make a 30-year fixed payment. Not a fixed payment, a 30-year payment, because it was not a fixed loan. Or you can make a 15-year payment. Now, what do most Americans do? We look at debt as a tool. So people see a 1% payment. Why would I pay anything else? I'll just make that payment. Well, that was fine in 2004 because the interest rates were so low back then, the index that these loans followed, and I'll back up on that. So those adjustable rate mortgages, they follow an index plus a margin. So if your margin is 0% and the index is at 1%, that means your rate is 1%. So if you have a starter rate of 1% and your actual rate is 1%, because that's where the index is at that time, then making that payment is actually paying down your mortgage. You're making a full payment. But as the Federal Reserve raised rates 0.25%, they do that 4 times. Now let's just say that the fully indexed rate, the index plus the margin, is at 2%. Well, if you're making that 1% payment and the actual rate is 2%, there's 1% that isn't getting paid. And every month that was getting tacked onto people's loan balance. So instead of having the loan balance go down, the loan balance was actually increasing. Well, that went from 1%, then to 2%, 3%, 4%. Now, using that same example, if I'm making a 1% payment and my actual rate is now up to 4%, the amount of interest I'm deferring onto my loan balance is massive. And there were limits to how far you could go. So what happens when you reach that limit? The bank says, hey, you can't make the 1% payment anymore. We actually need you to pay the full payment. Well, now, because the Federal Reserve raised rates, what did I say, 3%, almost 4% over the course of 2 years, right? 4% over 2 years. Hey, we need you to pay 4% now. I know you're comfortable with 1%, but it's actually 4%. I don't have the ability to do that. Well, you have to. There was options. These terms were outlined. I can't afford a 4% payment. I didn't know you were going to jack rates like that. And because I've increased my balance and I didn't put any money down to begin with, here's the keys. There's no value in this. There's no reason for me to continue paying because I'm upside down on my house. So why do you want me to make a payment that I can't afford on a house that has no value or no equity in it anymore? Here's the keys. And that's what caused the 2008 crash. They were loans that should not have been available to everyone. They are great loans for certain people, but they are not great loans for everyone. And it was all fine until the Fed started raising rates, right? People didn't keep up with it. So what have we seen this time? We saw the Federal Reserve raise rates over and over and over and over again for the course of the last 12 months. And as a result, something had to give. And Silicon Valley Bank, unfortunately, was the first thing to go. Now, here's the biggest difference, and this is why this is not a 2008 situation, at least not for housing. The loans everyone has now are 30-year fixed loans. They're fixed rate loans for the large majority. So me, for an example, all of the Fed rate hikes have had zero impact on my mortgage. I bought my home in 2021. I have a fixed rate on a 30-year fix at 2.625. As the Fed raised rates, my payment remains the same. There's been zero impact whatsoever. The people that had the adjustable rates back in 2008, every single time the Fed moved rates, they were dramatically impacted. That's the biggest difference, and that's why this is not an '08 situation. The other thing you have to think about is the amount of equity that people have in their homes. When people have equity, there's really no reason to foreclose. You could just do a traditional sale. And again, they're not necessarily going to be into a forced situation to sell because their payment is fixed and it remains the same. And most people are buying not based on what they could qualify for, but they're buying what they're comfortable with. That's another big difference between 2008 and now. What I always said back then, '04, '05, '06, everybody was going broke to look rich. They would overextend themselves to make it look like they had this big, great lifestyle, and then the cards just came crashing down. Well, these days, all of my clients, they don't do that. They can afford, from a qualification perspective, the banks say, hey, you can borrow more money than that. But they don't want to. They want to stay within their comfort zone, within their own personal budget. They're not trying to impress anybody. So as you're looking at what's going on with the banking situation, and it is a big deal, I'm not downplaying it at all, but this is not 2008. I don't want anyone to think, oh my gosh, the housing market's about to fall apart, because this is exactly how 2008 started out. 2008 started off in '04, '05, '06. It was the Federal Reserve increasing rates month after month, say meeting after meeting, 0.25% at a time, little chunks, and then all of a sudden, wait, we can't afford these houses anymore. Here's the keys back. We lied about our income. We didn't put any money down anyways. Very different than today. Today, every little detail of income, assets, and credit is verified, and the payments are fixed. So that's a very important thing to think about, whether you want to buy this year or not. I don't want anyone to hold out thinking, oh my gosh, all the foreclosures are coming. It's just not going to happen. I'll say, unfortunately, for those who want it because they think that they'll get a lower price if there are foreclosures, it's just not there. And with interest rates where they are today is March 21st, we already have multiple offers on every single property. I had a client make an offer on a property today. There were 4 preemptive offers, meaning the offers came in before the offer date. I have not had a client make an offer on a property since January that didn't have multiple offers. One of them had 30 offers. So due to the supply and demand issue, we're not seeing a decline in values, and you're not going to see a mass wave of foreclosures because people can afford their mortgages this time around. They're not increasing month after month like they were in '08. So I hope that's helpful. Comment below. Let me know what you think. Let me know what else you want to hear about. This is not my first rodeo. I've been here, I've done that. I learned the hard way the first time, and my goal for all of my clients is to make sure they don't. I want everyone to learn from the hard lessons I learned back then, and I want you to be a successful homeowner. So let me know how I can help. Thank you so much, and I'll talk to you soon. Cheers.